So now we are ready to start filling out the sales assumption section. So here we gonna begin by saying that the dollar per square foot is gonna be $500. So this is the dollar per square foot. This is how much will be sold per square foot. So if we take that amount per square foot and we multiply it by the total number of units, we will get the dollar so we multiply by the average unit size and we get the dollar per unit. So that will be the sales in this case. And then for the total sales, it's just going to be this number. And then we multiply it by the total number of units to get the total sales for 60 units in this case. So for the commissions, it's going to be based on 4.5% commissions that will be paid based on the sales price. So commissions on sales will be 4%. Then we multiply it by, we're gonna cut it half, so 50-50. So it's gonna be 4%, but we cut it half, and then we multiply that by the sales price. Okay. So in this case, we're gonna make this negative because it's a cash outflow. Since we want to account for the net profits, that is the gross profit after sales. So now we're gonna take this number for per square foot and per unit basis. So we divide it here by the total number of units, and then we divide it by the total average unit size for per square foot in this case. And then for the warranty, we already have it in dollar per unit, so we'll account for it in what is the total warranty in this case. So we multiply it by that number there, and then average unit size, the dollar per square foot, we have it there. So the net profit is gonna be the sales, and then we deduct the sales commissions and the warranty, and then we can take it and fill it to the right with Control R. So as you can see, the total net profit per unit is approximately $650,000. So now we are just gonna fill these commissions here. So in this case, we are accounting for the cost in positive. So we are using a positive sign to account for the cost. So we're just gonna fill it there like that. And then for the per unit and per square foot, we'll just copy this formula, paste it here on ESF as formulas. As you can see, we go after it's picking up the right numbers. So for this development project, we see that the total cost is approximately $30 million. And then we see that for per square foot, it's this amount, and per unit is this amount, and per square foot this amount. And then we have our pre-construction spending here, which we will later use to drive our construction spending in the cash flow and waterfall schedule. So hopefully this gives you a better understanding on how we use certain assumptions to drive our revenue and our cost going forward in our real estate development project. So the last thing we're gonna do here is just to say that to account for the maximum loan amount, which is gonna be based on, we'll say equal to 70% of the total cost. So this is how much this real estate project will be borrowing from its investors. So this is how much the lenders will be lending as a result. So the equity is going to be the difference between whatever is borrowed and whatever is contributed by the lenders. The difference between the total cost and whatever is contributed or borrowed to the lenders. So the difference between the amount and whatever the lenders are contributing, that's the equity that will be financing this project, approximately $9 million. So this is what the total amount of equity that will be coming from the equity investors. So we have the land loan amount. So these are the draws that will be modeling later on in our model. So pretty much this gives you a better understanding of how to set up an assumption schedule for a real estate project. So see you in the next video when we'll begin to construct the cash flow waterfall, and there you will see all kind of nasty if statements and how we use that to drive revenue. We use that to drive the focus on the cash flows of this project.